Hello and welcome to another video where today I'll be covering what a flexed budget is, how it's used by a business and how to actually create one. Now before we dive into this flex budget, I think it's worthwhile just giving a moment to recognise a tip of the hat, if you will, what a fixed budget is. A fixed budget compares the original budgeted costs at the start of the year with the actual costs that a business incurred throughout the year. Now that in itself is a handy tool because it allows a business to compare how the original budgeted figures worked out. It does, however, have a slight problem. See, the original budget will have been created based upon producing a certain amount of units throughout the year. And if the business actually did produce that many units, so the planned or budgeted number of units, then comparing budgeted costs to actual costs would make perfect sense. The problem comes where a business doesn't make the same number of units as what was originally budgeted. The reason being that you're then comparing costs that were budgeted based upon a certain amount of units with the actual costs that were for a different amount of units. So effectively the comparison no longer makes sense. If we imagine for a second that we budgeted based upon making 10,000 units of a product and we actually made 20,000 units, and obviously the costs are going to be higher, you've made double the units. This is where the flex budget comes in, because what we do is we alter the cost to be proportional to the actual number of units made. This allows the business to analyse the data and compare fairly between the flex budget figures and the actual figures. The flex budget is therefore a reflective budget that would have been produced had the business known exactly how many units it would make. One of the first things you, as a potentially budding accountant, or the business needs to take into account when flexing a budget is cost behaviour. Not all costs built into the original budget should be flexed, as we know that not all costs are based upon the number of units produced. And yes, fixed costs, I'm looking at you here because we know that you don't vary with the number of units produced. With that in mind, the costs that need to be flexed are the variable costs, and that includes the variable part of any semi-variable costs. Now that we've had a look at what a flexed budget is, let's think about how it's used. It's important for all businesses that they have a financial plan, and budgeting plays a big part of that. Having a solid foundation for what the business plans to generate and to spend throughout the year allows the business to make smart financial decisions. It enables it to plan its resources and hopefully allows them to plan for growth. However, the caveat to this is without proper monitoring, it all becomes a bit pointless, because how does a business adapt throughout the year without comparing actuals to budgets? Using the process of flex budgets, it will make this analysis far more meaningful by being able to assess management on their performance, set more realistic and accurate goals for the future, and potentially free up some of their resources for investment into more profitable ventures. Now let's look at an example to put this into practice and see how it actually works. Munda Difflin Limited budgeted to make 54,000 units of product X. However, the actual production for the year was 50,400 units. Calculate the flex budget and the variances for September and then show whether they are favourable or adverse. So you'll see within the table on screen now that we have the original budgeted figures shown in the second column and the actual figures incurred within the fourth column. The first step is to show the number of units that we're now flexing the original budget to. In this case, the original budget was based upon 54,000 units. However, only 50,400 were made. The flex budget, therefore, will be based upon 50,400 units. The process then is quite simple. Take the variable figures and divide them by the original budgeted units. This gives us the cost for one unit. We then multiply by the actual number of units produced. Let's start with the sales revenue. This would be 864,000 divided by 54,000 units and then multiplied by 50,400 units to give you a flex sales revenue figure of 806,400. Moving on to direct materials, this would be 159,000 divided by 54,000 units multiplied by 50,400 to give you a flex direct materials figure of 148,400. Next would be the direct labour, and this would be 186,000 divided by 54,000 units, multiplied by 50,400 to give you a flexed direct labour figure of 173,600. We then have our fixed overheads. Now, as these are fixed and therefore not linked directly to how many units are produced, these would remain the same and therefore be left as 110,000. Last on the list would be profit from operations, which can now be recalculated based upon our flexed budget figures. This would therefore be the sales revenue minus the direct materials minus the direct labour minus the fixed overheads to give you a revised profit from operations of £374,400. Now that we've flexed our figures, we can now calculate the variances between the flex budget and actual figures. To do this, we just need to find the difference between the flexed amounts and the actual amounts. So nice and straightforward, sales revenue would be 806,400 minus 840,000 to give you a difference of 33,600. Direct material would be 148,400 less 159,600 to give you 11,200. Direct labour would be 173,600 less 151,200 to give you a difference of 22,400. And fixed overheads would be 110,000 minus 136,000 to give you a difference of 26,000. And then lastly, we've got profit from operations, which would be 374,400 less 393,200 to give you a difference of 18,800. The last step will be to determine whether the variance is favourable or adverse. Remember that any income or profit figures where the actual is higher than the flexed will be favourable. On the flip side, any costs that are higher than the flexed would be seen as adverse because it means the business has spent more than what they should have done. Let's take a look at each line. The actual sales figure was higher than the flex figure and therefore favourable. The actual direct materials figure was higher than the flexed and therefore adverse. The actual direct labour figure was lower than the flexed and therefore favourable. The actual fixed overheads figure was higher than the flexed and therefore adverse. The actual profit from operations figure was higher than the flexed and therefore favourable. So overall, the business had a favourable outcome, but remember that all variances mean that there has been deviation from the original budget and therefore may need investigating. And that wraps up this video on flexed budgets. Hopefully you found this useful, and remember, if you have, to hit that like button and subscribe to the channel for more accounting videos. Also, be sure to go check out my Instagram page for more accounting tips, and I'll leave the links to that in the description below. Thanks again for watching. I'll catch you in the next one.